Hi, I'm Sam Chandan, the founder of Chandan Economics. The research teams at Arbor Realty Trust in Chandan have just released the third quarter small multifamily trends report. This report covers investment activity, pricing, financing for relatively small multifamily assets in the United States, typically those obtaining mortgages of $7.5 million or less. Amongst the key findings of the report, prices for small multifamily assets increased by 1.3% in the third quarter as compared to the second quarter of this year. In addition, in our revised estimates for the second quarter, the decline that we observed earlier this year was not as significant as in our initial read of the market. As compared to a year ago, small multifamily asset prices are just about flat, up 0.1% as compared to the third quarter of 2019. One important interpretive issue here for us is that during any period of stress in the market, whether it be for multifamily assets or any other asset class, there tends to be a bit of selection bias, where the assets that get transacted are of relatively better quality. So when we're thinking about what does that slight increase from the second to the third quarter mean, in part, it could reflect that relatively higher quality assets were trading in the third quarter as compared to what we saw in the pre-pandemic period. In terms of lending volume, the annualized numbers for 2020 show us down about 12% as compared to last year. In part, that reflects that there's been a significant decline in the number of arm's-length property sales, but those have been significantly offset by an increase in refinancing volume as current borrowers with significant equity in their assets have taken advantage of historically lower rates. To put that decline of 12% in context, of course, we've seen even much larger declines in the retail sector, in the hospitality sector, and even in the office sector. Multifamily, as we've seen throughout this downturn and throughout the pandemic, has performed relatively well and exhibited a significant degree of stability, both in terms of the underlying fundamentals, those occupancy and rent measures, as well as access to capital and financing. That 12% decline in lending volume that I described, again, in part reflects a drop-off in investment activity, but a significant increase in refinancing volume. If we take a closer look at that, what we see is that 78% of all of the financings in the small multifamily sector during the third quarter of 2020 related to refinancings of existing loans in the market. Again, capturing that debt financing liquidity remains strong in the multifamily sector, significantly attributable to the continued role and support of both Fannie Mae and Freddie Mac in the market, and the relatively strong underlying fundamentals of the multifamily assets against which loans are being made. As compared to some of real estate's hardest hit sectors, including retail and hospitality, cap rates for multifamily assets have remained quite stable over the course of the 9 or 10 months since the beginnings of the pandemic. If we look at small balance specifically, what we'll see is that cap rates actually came down a little bit to a market average of 5.3% during the third quarter. In part, again, this reflects a significant increase in the number of properties that are being refinanced and some potential endogeneity in terms of what assets are actually transacting. As I mentioned previously, during these periods of stress in the economy, in the real estate market, it tends to be relatively higher quality assets that are actually able to obtain the most favorable financing. In spite of those cap rates coming down, and of course that reflecting in part the significant and persistent decline in the risk-free rate of the market, spreads overall between the risk-free rate and multifamily cap rates, small balance cap rates, have actually edged up higher. And that's what we would expect to see again in any period of stress in the economy and real estate market, and in spite of the fact that the multifamily sector is continuing to perform so very well. When we take a closer look at cap rates for small multifamily assets, what we see is that those cap rates did come down in the third quarter. Now, that in part is capturing that risk-free rates are at historic lows. The spreads between the risk-free rate and the small multifamily cap rate have actually widened out a bit. But the other thing that's notable is that as compared to the multifamily market overall, small multifamily cap rates, the gap between those two has actually narrowed. And it's at one of the narrowest points that we've seen since before the financial crisis. What is that capturing? It's capturing in part that the tenant in the small multifamily asset is more likely to be a renter by necessity as opposed to a renter by choice. We've not seen many of those renters actually leave their apartments where they've lost their jobs. Certainly for some part of the third quarter, they were still able to take advantage of and use enhanced unemployment benefits and other provisions of the CARES Act to continue to make those rent payments. So those occupancy rates remain relatively high, and the underlying fundamentals of the properties remain more stable than those worst case scenarios that we might have anticipated when we were talking about mass evictions earlier this year. Compare that to the Class A luxury building. And in that case, what we see is that this is an area where some of the pressure on the multifamily sector is actually observable. Some of those Class A renters being renters by choice, and over the last couple of months, making a decision to actually shift from being a renter to being a homeowner. Some of those gains that we're seeing in first-time home buyers then, in those first-time home buyer sales numbers, capturing a loss of rental occupancy for those Class A luxury buildings. And so with that impacting the underlying fundamentals performance and the investment attractiveness of some Class A, very large properties, not too much surprise that we've seen the cap rates between the multifamily sector overall and the small multifamily assets that, again, are exhibiting more stable fundamentals, at least for now, have narrowed a little bit.